Hey, what's up, everybody? Welcome back to the Engineered Impact Podcast. I'm super excited about our topic today. I want to talk about something that I'm actively working on right now that has me super stoked. The last couple of episodes, we talked about inflation, which is one of the most insidious things that erodes the power of your wealth over time. When you're saving for retirement in a traditional way, you're trying to build up this large net worth, hope you have enough cash that you don't outlive it. One of the things that's going to impact you more than anything else is inflation, right? The steady erosion of your purchasing power over time. And we talked about how, that's kind of a stealth tax that comes because the government is printing more money than it spends or than it takes in tax revenue so that it can spend more than it takes in. And so they're just kind of silently year in and year out stealing your purchasing power. Okay. But in the last episode, we talked about some of the ways that we can counteract that effect, or at least mitigate that effect. Okay. Today, I want to talk about one of the best ways to take advantage of what's going on right now. Okay. Because we have this crazy scenario where the government is printing insane amounts of money. Okay. In response to COVID, the government printed like $3 trillion in a matter of months. It's insane. The federal deficit for the government's fiscal year 2020 that ended at the end of September, it's mid-October right now, 2020, was like 3 times the previous record for debt. It just mind-blowing amounts of money that the government is creating out of nothing. Okay. Now, eventually, right now, that's not really showing up in inflation, but over time, that is going to destroy the US dollar. Okay. So, one of the best things that we can use to mitigate the influence of inflation on our personal finances is hard assets like real estate. Okay. Real estate is probably the one that more people are familiar with than anything else. Okay. So, what I really want to talk about today is refinancing your primary residence. Okay. I want to talk about what that is. I want to talk about why you would do it, the different options there, who it makes sense for, who qualifies, why you would do it, things like that. Okay. So this might be a little bit of a longer episode, but I really want to go through this because my wife and I are in the process of refinancing the house we just bought, like, what was it, 9 months ago, 10 months ago. We'd moved into this house. We're already refinancing the mortgage. Okay. I tried to refinance 3 of our rental properties. It turned out only one of them it was going to make sense for, but we are doing everything we can to take advantage of the crazy low interest rates right now. Because that's the other thing, right? In addition to creating trillions of dollars out of nothing, out of thin air, interest rates are going through the floor right now. And it's such a good time to take advantage of this. So I'm going to dive into this. I apologize if this gets a little bit basic for some people, but I've realized as I've been talking to people about this, that some people have just never really considered doing it. They've heard about refinancing, but they don't really, they're not really familiar with what it is, how it works, whether it makes sense for them or not, and what the benefits are. So I'm going to start super basic. If you're bored, speed up the video. But I want to make sure this is useful for everybody. So at a basic level, what is a refinance? Okay. So when you bought your primary residence, chances are you got a mortgage on that, right? You brought some cash, maybe it was 5%, maybe it was 20% down. So say you bought a $300,000 house, you put a 20% down payment, that'd be $60,000. Okay. So you took out a mortgage from a bank for $240,000. Okay. What refinancing does is you're going to get a new mortgage on your house using your house as collateral, just like you did the first time, but it's going to pay off the old loan. And now you're going to have a new lender. Okay. So why would you ever do that? Right. Well, there's a couple of ways that you can do this. The first is called just a rate and term refinance. So basically what you're doing is, let's say you took out a 30-year loan originally. Maybe you've been paying on that for 7 years. The average mortgage is held for 7 years in the United States. Okay, so let's say you bought a house in 2013. You've been paying on that mortgage for 7 years. Now that's 2020, and so you're going to owe something less than that, right? And so what you could do, let's say you owe $200,000 out of that original 240. Okay, so what you can do is you can take that $200,000 loan and basically spread it back out over 30 years. Okay. But what's cool about it is, one, just spreading it back out is going to lower your payment. Refinancing at a lower interest rate today is also going to reduce your payment. Okay, we're going to look at some numbers in a few minutes. I'll show you the impact of doing this. Okay, so that'd be one option, is you just take your existing balance, spread it back out over 30 years at a lower interest rate, and both of those things are going to keep more money in your pocket every single month. Okay, the other thing you could do with a rate and term refinance is, let's say you had a 30-year mortgage originally, you've held it for 7 years, you're making more money today. Let's say that your financial plan will benefit if you can get out of debt faster. Okay, so you can get a 30-year mortgage, you can get a 15-year mortgage. Those are the two most common. So let's say you want to take that $200,000 balance and spread it out, but only over 15 years. Okay, so that's probably going to increase your payment, but because you can lower your rate so much today, the impact may not be that much. It may not be that much more, and you can pay it off, quite a bit faster. So if you've been paying on a 30-year mortgage, you have 23 years left, you could refinance and have it paid off in 15 years. So save yourself 8 years of interest payments. Okay, so that's another way you can do it. A third thing you can do with a refinance, and this is one of the coolest things if you do it right, is what's called a cash out refinance, where you actually leverage the equity that you've built up in your property, both by paying down the mortgage and from appreciation of the price. You can actually get the bank to not only give you a new loan, but actually cut you a check and give you cash for the equity you have in your house. Okay. And if you use that cash smartly, you can do some pretty cool things with that. All right. So those are kind of three options, right? Rate and term, where you either spread it back out over 30 years, you reduce the term, but both of those you would do a lower interest rate. And then the third is cash out, where you're actually going to walk away with cash in your pocket. Okay. So why would you do these things? All right. The biggest reason is lower your monthly payment. Okay. It's a great way to improve your cash flow position every single month. Okay. And again, that's just because you're spreading the loan balance out, and you're spreading it out over a longer term. In the case, the second case I talked about, where you reduce the term from 30 years to 15, like I said, likely that's going to increase your payment, but you're going to get out of debt years faster than you would otherwise. And the third reason is the cash out, right? So there's different reasons you want to do that, but who doesn't like a big check in their pocket, right? Cash is options. So those are kind of the main reasons you do it, is either to reduce your payment, reduce the length of time it will take you to get out of that mortgage debt, or to get cash. Okay. So who qualifies to do this? Well, what I've learned is you have to have some equity in your house. Okay. So I mentioned I had 3 properties, rental properties I wanted to refinance. I was only able to do one. And the problem was the other 2, I just hadn't held them long enough to actually have enough equity to process the refinance. There's some extra rules when you're refinancing an investment property. You have to have a little bit more equity than you do if it's a primary residence. So those 2 properties, unfortunately, just didn't qualify yet. But so you do need equity in your home. Especially if you're going to take cash out, you're going to need at least 20% equity. Okay. So if you had a $300,000 home, you're going to need to have at least $60,000 worth of equity in there in order to, or that's the max loan to value you'd be able to take out. So if you only had that 20%, you wouldn't be able to take any cash out. Okay. You're going to need a credit score, because you do have to qualify for a new loan. Okay. So you're going to need a decent credit score. I think usually they define decent credit as, anything above 620. If you have 720 or higher, you have a much better shot at actually qualifying for the best rates that are available today. Okay. And then the other thing you're going to have to look at, that the bank is going to look at, is your current debt to income ratio. Okay. So what they're going to want to see is, when you get this new loan, what does that do to your debt to income? And that's exactly what it sounds like. They're going to take all of your monthly debt payments. They're going to compare your income and see what percentage of your income, your monthly income, is consumed by obligatory debt payments. Okay. So they're going to look at your mortgage. They're going to look at your car payments. They're going to look at credit card payments, utilities, and all that stuff. Right. I don't know what the magic number is. I think it's somewhere in the neighborhood of 30-ish%. So if all of those payments added up, your minimum credit card payments, your mortgage payments, utilities, car payments, et cetera, if all of those things are higher than 30% of your income on a monthly basis, You may not qualify. You may end up with a higher interest rate. So those are kind of the three things to look at, right? How much equity do you have? What's your current credit score and your debt to income ratio? Okay. So that's kind of why you would do it. That's what these things look like, and that's what it takes to qualify. Okay. So what I wanted to do is actually share my screen here and run you through a couple of scenarios and just kind of show you the potential benefit of doing this. Okay. So the first example here is a rate and term where you're just going for a lower rate. Okay. So again, I used an original home value of $300,000. I assumed you put 5% down. So you took an original loan of $285,000. Okay. So if you took that out as a 30-year loan, and let's say originally you had a 4.5% interest rate. Okay. Interest rates fluctuate all the time. So this is just kind of an imaginary scenario. Okay. But your original principal and interest payment on that would be $1,444.05 every single month. Okay. So let's say now you've been paying on that loan and the balance now is only $240,000. Okay. So you've paid off $45,000 worth of principal. Okay. So if you were to take that same loan and go back to the bank and say, hey, I'd like to spread this $240,000 now back over 30 years. But today, so just doing that is going to lower your payment. Okay. But today, instead of a 4.5% interest rate, you can qualify for a 2.8% interest rate. Okay. That's what, from what I could tell, that was about the average rate today without paying any points. Okay. A point is just a percentage. It's 1% of the value of your loan. Okay. So on a $240,000 loan, 1 point would be $24,000 or $2,400, excuse me. Okay. And what banks will do is they'll say, look, we'll give you a 2.8% interest rate, but if you pay us a point, you can buy that rate down to, I don't know, 2.3%, something like that. Okay. So why would the bank give you a lower rate? Short story, the bank doesn't really care about your interest rate. What the bank wants is cash. Okay. And so that cash goes straight in their pocket right from the get-go. Okay. And so that's why they'll do that, because they know you care about the interest rate. They don't, they just want your cash. And so if they can get you to pay them an extra $2,400 right up front, that's a win for them. Okay. All right. So why would you do this? Well, if you can spread that loan out over 30 years at a 2.8% interest rate, the difference is your new principal and interest payment is only $986 a month. Okay. So you saved $458 every single month. Okay. That's, I don't know, that's $5,000 a year that's staying in your pocket rather than going to the bank. Okay. That's awesome. $5,000. Okay. Now, you are going to have to pay for the privilege, right? You're going to pay fees just like you did, closing costs, just like you did on your original loan. The actual bank fees are going to be usually somewhere on the order of $2,500 to $3,500. Okay. And I'll talk in a minute about kind of paying attention. That's a big thing you want to pay attention to, is what are the closing costs going to be? Okay. They should be somewhere in that range, $2,500 to $3,500. If they're not, keep shopping. Okay. Now there's other things you're going to have to pay. You're going to have some prepaid interest. You're going to have some prepaid homeowners insurance, things like that. But that ends up being kind of a wash for several reasons. Just take my word for that. That'll end up being a wash. The numbers you really want to pay attention to are what are the bank fees, because that's really the cost of the loan. Okay. So let's pick the middle of the road, that $2,500 to $3,500 range. Let's say it costs you $3,000 to do this refi. Okay. Well, if you're saving $458 a month, that means in 6.5 months, you've essentially made back your $3,000 that you paid out. And for the next 29.5 years, you're saving $500 a month, right? Super worth it. Okay. That is absolutely worth laying out $3,000. Okay. So that's the first scenario. Scenario number two. Okay. Let's look at what happens if our primary goal is to get out of debt faster. Okay. So we had that same loan, $285,000 at 30 years and 4.5%. Okay. Now we go to the bank and we say, look, I only owe $240,000, but I'd like to take out a 15-year loan. Okay. Well, the bank is going to give you a lower rate on a 15-year loan because that means they get their cash back faster. Okay. Remember, the bank doesn't care about the interest rate. They want cash. Okay. So if they get their cash back in half the time, they're willing to give you a 0.5 point advantage on the interest rate. Okay. So what does that do? Well, that's going to raise your payment. Remember I said, because you're shortening the term of the loan, your payment is generally going to go up. Okay. But because you're dropping the interest rate so much, your payment's only going to go from $1,444 to $1,577. Okay. So it's going to cost you an extra $133 a month, but you get out of debt in half the time. Okay. So you got to decide if that's worth it to you. To me, I can't foresee a scenario where I would ever get less than a 30-year loan. Okay. Because I can go do the math and figure out how much do I need to pay every month to pay it off in 15 years. And if that's important to me, I can go do that myself. I don't have to have the bank send me a statement that tells me how to do that, right? I can go figure it out and just make extra payments to pay it off in 15 years. But the reason I'll never get, I can't foresee a scenario where I'd ever get less than a 30-year loan if I can qualify, is because there's a couple of reasons. One, that gives me a lot more flexibility, right? If something happens, I lose my job, whatever, I'm only locked into this $986 a month payment. Okay. Whereas if I have a 15-year mortgage, I have to come up with that almost $1,600 payment every single month. Okay. So I would rather get the 30-year mortgage, only have to come up with $986 a month. So if I hit a rough patch for a while, I have a lower cash burden, right? And so if I'm trying to pay it down in 15 years, lose my job, car accident, whatever, and I need to take a break for a few months, I have the flexibility to do that. Okay. So that's my personal preference. But that's up to you. So those are the kind of the two main options you'd have with a rate and term refinance. Okay. Now let's look at the cash out refi. What could that look like? Okay. So got a few more numbers here. Okay. So let's say original value of the house was $300,000. Okay. We took out a loan again, $285,000, 30 years at 4.5%. That same payment, $1,444. Right. Okay. Well, now let's say the value of our home is increased to $350,000. Okay. And let's say that we still only owe $240,000 on it. Okay. Well, to do a cash out refi, you're going to have, if you owed $280,000, you couldn't take any cash out because you only have 20% equity. Okay. But because you only owe 240, you can borrow or you can take out the difference. You can borrow the difference as cash out, and you could take that $40,000, stick it in your pocket, and add that to your loan balance. Okay. So if you did that, now you have your loan balance is going to increase from 240,000 to 280,000. Okay. But check this out. Okay. I'm going to spread that balance back out over 30 years. Okay. So I still have a lower balance than I started with, right? This new loan is $5,000 less than my original loan was, spreading that back out over 30 years. But now my rate has dropped from 4.5% to 2.8%. Okay. So look what that does to your payment. I went from $1,444 down to $1,150. So I'm still saving $300 a month, and I'm walking away from the deal with $40,000 in my pocket. Okay. That is cool. That is powerful. Okay. Real estate is one of the two most powerful wealth building tools there is. Okay. The other one is owning your own business, but real estate is the easiest way for normal people with a W-2 job to build wealth over time. Okay. This is why the government is willing to subsidize insanely low rates for 30 years, because owning property is the best way for their citizens to build wealth over time. Okay. This is the best way to create a prosperous society. One of the best ways. Okay. So basically the idea with a cash out refi is you get to tap that wealth building power. Okay. One of the ways that real estate builds wealth is it appreciates. Okay. Prices go up over time in general, right? They don't always go up. We all learned that in 2008, right? But in general, prices grow at about the pace of inflation. Okay. So what should you go do with this $40,000? A lengthy discussion of that is probably for another episode. Okay. But let me just say this now. The best thing you can go do with that cash, the most powerful wealth building thing you can go do with that cash, is to either make investments in yourself, enhancing your mindset, developing new skills, starting a business, whatever. or taking it and reinvesting it. Okay. So for example, you could take that $40,000 and you could go buy a rental property. Okay. That's 20% of a $200,000 house. Okay. So you could go buy a $200,000 rental property, and basically start doing this all over again, right? So now you're building wealth in your primary residence, and now you have a second property that, if you're doing it right, is producing cash flow, putting cash in your pocket every single month. It's giving you tax benefits, even more tax benefits than your primary residence is. It's also appreciating in value and giving you equity that someday you'll be able to tap. And you've got a resident in that house that's paying down your mortgage for you and building additional equity that someday you'll be able to tap. Okay. So taking that cash and reinvesting it either in a mindset, building your network, building new skills that will allow you to go out and create more value, and earn more income, or taking that cash and buying another investment that will grow and increase your cash flow. Those are the two most powerful things you can do with that cash. Okay. Now, obviously, there are other things you can do with it, right? Commercials abound telling you can take that and add a bathroom to your home. You can go buy that car that you always wanted. You can go on that dream vacation, right? And you can do whatever you want with that 40 grand. Okay. I will just say, by way of caution, that you are increasing the value of your loan. Okay. You are taking on that debt. So that's not free money. You are taking debt. Okay. So good debt means you're taking that debt and you're putting that cash to work productively, right? Buying an investment, investing in a business, whatever it is. Bad debt is consumer debt. Okay. If you're taking on debt to go on a vacation or to add to your home or whatever, you have to be very careful of that, right? I'm not going to tell you to never do that, but you have to be careful of it. One of the biggest reasons people got in big trouble in 2008 is people were using their homes like ATMs, right? They were taking it and they were going on fancy vacations. They were buying cars they shouldn't have been buying. They were adding onto their homes when they shouldn't have been, whatever. You have to be careful, right? Debt can get you in trouble. Leverage is by far the most powerful way to build wealth. But it's also the most dangerous. You have to be careful of it. So my recommendation is take that cash, leverage it to go create more wealth. Okay. All right. So we've covered the kind of those three main options, right? Cash out refi, reducing the term of the loan, 30 years to 15 years, or just spreading the loan back out over 30 years and reducing your interest rate. Okay. And we've kind of looked at the impact of doing all those things. All right. So what is the process of this? What does this look like? Okay. Well, it's a lot like getting a regular mortgage. Okay. You're going to call around, you're going to talk to some lenders, talk to some friends that have done this, talk to local real estate agents, get recommendations of good lenders. Okay. Call them up, find out what kind of rates they're offering, find out what their closing costs are. I will caution you to avoid things like Quicken Loans or Rocket Mortgage or some of these super flashy mortgage places. They do a good job. They close loans quickly from what I understand, but from what I can tell, their fees are very, very high. I have an investor friend that was trying to do an investment loan through, I think it was one of those Quicken Loans or one of those bigger, more popular companies. And his closing costs were like 3 or 4 times what I was seeing on my loans. Okay. And so it pays to shop around because again, those closing costs really are your only cost to this. Okay. So you want to reduce those as much as you can. Find somebody that's going to get you in that range of $2,500 to $3,500. Okay. Next thing is the lender is going to call you up. They're going to talk through what your goals are. Do you want to do a cash out? Do you just want to reduce the payment? Find out what your goals are. And then they're going to ask you for a ton of paperwork, just like they did the first time. You're going to have to send in pay stubs and bank account statements and tax returns and blah, 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 right? It's going to go on and on and on. Tons of paperwork, but you're going to submit it to them and they're going to do all the work from there. Okay. Once they kind of get through all that, they're going to qualify you. And then they'll order an appraisal on the house. They'll come figure out how much the home is worth. They don't always do that, but they generally will, especially if they're going to do a cash out. They have to know what the home is actually worth to make sure they stay under that 80% loan to value ratio. Okay. When the loan's approved, they're going to call you and say, show up at the title company on X day. You're going to go, you're going to sign a whole stack of paperwork, just like you did when you bought your house, and you're done. That's all there is to it. They will do all the work of filing the loan. They're going to pay off your old mortgage for you. One of the cool things is that you usually, when you get a new loan, there's usually about a 1 month gap. So that you're going to have a month where you don't have to make a mortgage payment. Okay. And then when you get your next bill from that bank, it's going to be for the lower amount. Okay. And then you're off to the races. Okay. So that's the process. It's very much like getting a first mortgage. Again, just make sure that you're not getting screwed on the fees, right? Don't pay 10 grand in fees. There's no reason to do that. Okay. All right. So lastly, I want to talk about, should you do this? Okay. Well, that's really up to you. Okay. I've kind of laid out the benefits of doing it. You can increase your cash flow every single month. And that's money that you can do whatever you want with, right? You can add to your savings, increase your net worth. You can take that, save it up, and go buy additional investments. You can increase your budget for whatever you want to go spend on, whatever you want, right? More money in your pocket is a good thing. You can get out of debt faster. That's an option. Again, if you reduce the term 30 years to 15 and reduce the interest rate, you can get out of debt much faster without a lot of added costs. Okay. And then again, my favorite method of this is refinancing and actually pulling cash out and going to put it to work, either in a business, investing in yourself, developing new skills that you can then go use to increase your income, or investing that money in a piece of property or whatever your investment of choice is to increase your cash flow, increase your net worth. Again, I prefer real estate because now I've got 2 properties working for me, right? 2 properties that are appreciating, 2 properties that have loans being paid down and building equity. One of those properties should be putting money in my pocket every month, and I've got 2 properties that are reducing my taxes. Okay. So that's the process. Those are kind of the considerations, the things to watch out for, the reasons you'll do it. I hope this is helpful. If you've got questions, feel free to post comments in here. I apologize if you're not, if you're listening to this on iTunes or one of the other audio files. I know you couldn't see the numbers I was crunching, so I'd invite you to head over to the YouTube page, Engineered Impact, and check out the videos so you can actually see those numbers for yourself. All right. We will talk to you guys next time.